If you walk into a commercial bank today and deposit $1,000 in cash, where does that money go? Most people assume it sits safely locked inside a steel vault, waiting for you to withdraw it. But that is an illusion. The moment you hand over that cash, the bank does not keep it. They are legally allowed to lend up to 90% of it out to someone else. And through a fascinating mathematical loophole, that loan is deposited into another bank, lent out again, and lent out again, multiplying your original deposit tenfold. Private banks don't just store money, they create it out of thin air. Welcome back to the Banker's Desk. Today, we are opening the master ledger to deconstruct the core engine of global capitalism, fractional reserve banking. The Goldsmith's secret. To understand how banks legally print money, we have to travel back to 17th century London. Back then, wealthy merchants stored their physical gold bullion with local goldsmiths, who possessed the most secure private vaults in the city. In exchange for the deposit, the goldsmith issued a paper receipt, certifying that the gold could be redeemed at any time. Very quickly, merchants realized it was much easier to trade these lightweight paper receipts than to lug around heavy chests of gold. Soon, those paper receipts began circulating as currency. Then, the goldsmiths made a life-changing realization. Because everyone traded the paper receipts, the depositors almost never came back to withdraw their physical gold all at the exact same time. The vaults sat full of idle gold, so the goldsmiths began printing extra paper receipts for gold they didn't actually have, lending them out at interest. As long as only a fraction of depositors demanded their real gold on any given day, the illusion worked perfectly. Modern banking was born. The modern money multiplier. Today, physical gold is gone, replaced by digital ledgers. But the exact same mechanism governs our world through reserve requirements. Let's look at the basic math of how a commercial bank creates money. Imagine the central bank sets a mandatory reserve requirement of 10%. This means if you deposit $1,000 into Bank A, the bank is legally obligated to keep just $100 in reserve. They immediately take the remaining $900 and lend it out to a small business owner. Here is where the magic happens. That business owner takes the $900 loan and buys equipment. The equipment seller takes that $900 check and deposits it into Bank B. To the financial system, this is a brand new deposit. Bank B now keeps 10% of that $900, which is $90, and lends out the remaining $810 to someone buying a car. That $810 is then deposited into Bank C, which lends out $729. If you follow this mathematical chain reaction to its absolute limit using the Money Multiplier Formula, which is simply 1 divided by the reserve requirement, that initial $1,000 physical deposit legally creates $10,000 of new digital money circulating in the economy. Let this sink in. Commercial banks do not lend out existing money. Whenever a bank approves a mortgage, a corporate credit line, or a personal loan, they literally type new numbers into a computer ledger, expanding the national money supply instantly. The vulnerability of trust. But this system possesses a fatal vulnerability. Fractional reserve banking functions entirely on public trust. It relies on the mathematical probability that all depositors will never ask for their money at once. If a rumor spreads that a bank is financially unsound, panic ensues. If even 20% of depositors rush to withdraw their cash simultaneously, the bank realizes its vaults are empty. This is called a bank run. When a bank run occurs, the deposit multiplier collapses in reverse. The illusion shatters, and without immediate outside intervention, the commercial bank faces instant bankruptcy. This is precisely why modern financial systems require central banks and government deposit insurance to act as the ultimate lender of last resort, injecting emergency liquidity to guarantee that the fractional illusion never completely breaks down. Understanding fractional reserves reveals the ultimate truth of global finance. Money is not a physical commodity. It is a network of credit, debt, and institutional trust. If you want to master the laws, mechanics, and strategies that govern these financial institutions, make sure you subscribe to the Banker's Desk. Leave your thoughts in the comments below, and I will see you in the boardroom next week.